I wouldn't say the AI trade is over, but goodness, with Palantir down over 7% on Friday, Tesla and AMD down over 3% on Friday, it certainly feels like some cracks are starting to emerge. But if you watched Wednesday's video, you know that the rotation into other sectors has been crystal clear. And as long as that's the case, do not fight the grind higher, at least in the S&P 500. So welcome back to the Trade Brigade Weekend Show, where we'll take a look through all of the data points and we'll build a logical trade plan. My name is Matt, and if you're new here, hit the thumbs up button and subscribe. For additional resources, check out the links listed down below in the description, and stay tuned until the end of today's show. I've got 4 additional trade ideas to share with you that you won't want to miss. With that said, let's jump right into the charts. So we'll kick things off on the SPY monthly time frame now that the September bars have officially closed out. What do we see in terms of candle structure and location? Second candle in is September. Solid green-bodied bar with a very strong close near the highs of the monthly range. That's bullish. If we're thinking about location on the bar-to-bar count, notice the clear higher low, as well as the higher high, and more importantly, the candle close completely outside of and above the previous month's range. Buyers go 2 for 2 on the bar-to-bar count. Overall, this is a brand new all-time high as well, so we're inherently sitting in the highest high of the trend sequence, and therefore, although there's no indication of a pullback looking imminent, the market could pull back on the monthly timescale in search of a higher low and still maintain the monthly uptrend. Now, of course, one of the key levels that we'll continue to reference is the previous all-time high shelf here, around 610 to 613. A monthly higher low off of that level would certainly preserve the trend in the upward direction. The reason that this is important, especially right now, is online you're starting to hear a lot of chatter, a lot of noise about, oh my goodness, the bubble's going to pop, the market's going to crash and burn, it's going to be the worst thing in the world. Just remember that historically speaking, bad things typically only happen when the monthly trend actually flips to down. If you want to see examples of this, look no further than 2022. You can see we have a monthly high, then we set monthly lower highs. Notice that from here to here, you set monthly lower lows, and then the downtrend persists for a few more months into the end of 2022. But don't just take that example, go even further back and look at something like the Great Financial Crisis in 2008. You can see that the monthly sets a double top. Here is your monthly neckline of that double top. Notice that we break the neckline, we set a lower high, so the monthly trend is down, and then really bad things happen. What about another bubble example? Let's go back to the dot-com bubble bursting just a little bit prior to this, right? You could see we have the same thing, the monthly double top, so equal highs, not a higher high. You have lows, you bring in a monthly lower low. This is a monthly lower high. Bad things happen once, bad things happen twice when you're already in a monthly downtrend. So it doesn't mean that there's going to be no pullback. It doesn't mean that the market's not susceptible to downside volatility. Of course it is. But in terms of protracted down moves, like, oh my God, the market's going to lose 50% of its value, it's not going to happen when the monthly chart is in a monthly uptrend. Let's quickly come in with a Fibonacci from the very bottom of 2022 up to the most recent all-time high. And just point out that even if you were to overshoot this level in here, this is the last monthly higher low. You have higher low, and this is a higher low here from the tariff debacle. Notice that if we were to pull back past the previous all-time high shelf around that 613, 610 level, you're still over the monthly Fib 38.2 coming in from the 2022 low, which in my view would still classify all of this as monthly bull flag consolidation. Now, could the monthly trend flip to down in there in a very nuanced way? Of course it could, but we'll take that in stride when and if it happens. There's no sense in trying to call a major market top until the monthly trend actually has a true threat of flipping to down, which we do not have in the current configuration of this timescale. Let's drop it down to the weekly chart. Let's see what else we can learn about price action, a little bit more actionable for this upcoming week, huh? So let's take a look at candle structure and location as we typically do now on this timescale. You can still see a decent green-bodied bar in here, a little bit larger of an upper wick, a little bit larger of a lower wick. It's not a solid green-bodied bar. Nonetheless, I still find this structure quite compelling because we did close over the previous week's high after setting more of an indecisive doji. If you watched last Saturday's update video, you know that we were pretty, not maybe concerned, but open-minded to a test of these 2 back-to-back equal lows, possibly opening the door for a downside pullback. Nothing that would change the trend, but a possible pullback, and it just didn't happen. So candle structure, not inherently bearish here. Location, higher low, higher high, close over the previous week's high as well. So structure and location on the weekly chart also go to the bulls. If we're thinking about the trend here, it's still up, right? You have lows, higher lows, higher lows, higher lows, soft higher low. The daily trend never flipped it down. There's plenty of room here for a weekly higher low pullback. So once again, there's no indication that a pullback's imminent, but if the weekly chart were to do something that looks like this, no problem. You're still in a higher time frame uptrend here. I would not panic and say, oh my goodness, the market's going to crash and burn and go to zero. If we take a fib to the new all-time high, so if we could get a click, there we go. Notice that the fib 38.2 is confluence with this great level we've been tracking for the last little bit, between about 635 to 638. I would still also offer the idea that if we come in from the low of the tariff debacle up to the new all-time high, as the fib 38.2 slowly aligns for confluence here, once again, that is the beautiful spot for a possible monthly high or low. If the weekly chart were to get something like this, I would still argue that this is somewhat possible to call a weekly high or low, considering the daily trend has never really flipped it down in any of these instances over here. You had some close calls, but no real protracted daily downtrends that would set a firm weekly high or low. So uptrends across the board. Let's go ahead and take out our weekly anchored VWAPs here and check in on these. If you take a look, we're above the entirety of the stack, and once again, a pullback into this zone is kind of confluence with the first set of our anchored VWAPs. I would not be overly concerned if a pullback were to emerge. There's plenty of reference points underneath us to use as that possible high or low. Let's come in here with the volume profile. We're not going to really learn a whole heck of a lot of new information because, of course, blue sky territories leaves nothing above, but if we just bring out this high volume node shelf, it might mean if we fail back down into the 2-week range from prior, just zooming in back over here, this prior range here, if we fail more aggressively into that, I would just still continue to keep an eye on the 2-week equal lows there, which as we know are sitting roughly around about 654. 654 was the equal low from the FOMC low, which we could see on the daily time scale. So speaking of, let's go there now. Let's start the analysis with our expected move for the week. Let's begin by talking about this gray box right here. If you're not familiar with this study, check out the video tutorial in the top right-hand corner on how to set it up. If we're contained by the upper bound, the move and the number is up at 678.79, implying a new all-time high, and a higher high in the trend count, that's bullish. If we're contained by the lower bound, the number is 659.63, implying a higher low in the daily trend count. So expected move here is bullish, noting that it is suggesting that the uptrend will remain intact on the daily timescale. As we just saw on the weekly chart, I would start to be concerned about a weekly pullback when and if we were to make it back down here towards this 654. But what's the current situation of the daily trend? What's the analysis of the daily chart here? It really continues to look way more bullish to me than anything else. The reason I say that is because we're in a daily uptrend, right? You have lows, higher lows, higher lows. This was soft as well, but this is a firm higher low at the daily 20. Notice that your daily 20 is now actually right at the sweet spot. It's providing confluence with the bottom end of this 5-day balance range from here. It's providing confluence with the lower edge of the expected move for the week, which is a suggestion from the options market, right? So 660.40, if the market were to pull back and offer another daily higher low around this zone, I would love that as a continuation of the overall daily trend. There you go. Higher low pulling back from what? The highest high in the trend count. This is a brand new all-time high. Now, could this be a reasonable outcome early on in the trading week? I think the answer is absolutely yes. Why would I say that? Well, let's just take a look at candle structure from the Friday session. It's a little bit of an inverted hammer, right? So we know that we open inside of range from Thursday. We rally to break and set a new higher high, a brand new all-time high. But then where do we close on Friday? Back inside of Thursday's range. So if we were really going to have stronger buyers participating in this market, offering sort of price exploration, discovering new price in blue sky territories, you would expect to close up here outside of Thursday's range, and that's just simply not what we got. You could also start to see that on Thursday, we actually opened on a gap up, right? We opened over the high of the Wednesday session, and the market failed that gap up in terms of a gap and go at least. It did not continue on Thursday. The market needed a pullback. It needed to, quote, come back down to earth, so to speak, come back down to comfort, and it supported here. So I like the nuance of this level being sort of a line in the sand. Friday's low is very close to that area, and I would think that if the market were to take this level out right here, 667.25, then a pullback may emerge on the daily, but we know it's for a possible higher low at the 660.40 spot, which could offer confluence with that daily 20 SMA, the lower edge of the weekly expected move. Now that's if we break underneath that 667.25. If we just consolidate up here, there's nothing wrong with high and tight consolidation. Ultimately, this may just build out as a daily bull flag, in which case we're probably long into new highs over the top end of Friday with acceptance over 672.50. Right, that would be the number on the upside. So very simple daily chart. The trend is clearly up. A little bit of concern with that Friday failure to go higher. However, I would not just short the market in here. I would wait patiently for a move underneath this 667.25, potentially changing the hourly trend to down to offer the daily pullback into this level here at 660.40. If we really want to play devil's advocate and just take this one step further to address the bubble concern, the oh my goodness, the market's going to crash and burn concern, what would be required before I really start to lean into the bear side of this market is if we fail a higher low here at 660.40, and it could look something like this. We pull back and we make it here. We rally to set a daily lower high and then make an equal low here, right? Lows equal lows. That is where I become, much more concerned about the possibility of a larger reversal in the market. Now, could that happen? Of course it could happen, but let's not focus on that just yet. Let's take this one step at a time. First step is, do we or do we not early in the week break down underneath 667.25? And then the second step might be, does the daily 20 SMA offer another daily higher low? And in theory, the base case should be that we should go back through this, recapture, target the equal high, and then go through for a new higher high. What's the basic assumption of an uptrend? After you make a higher low, what do you do next? Here's a higher low, here's a higher low. You go on and you make a higher high. You go on and you make a higher high. That's the definition of an uptrend. And if we're in an uptrend, which I hope we can agree that we're in an uptrend here, right? If we can hold a higher low, then again, the base case becomes this higher low, thus, on the hourly chart, should target the equal high and continuation in the upward direction. New all-time high, right? So when and if we fail to make that, when and if we have a lower high here, when and if we have an equal low at 654, I will be the first one to raise my hand and say, hey, we're changing tone. It's no longer a clean daily uptrend, but we're just not there yet. So let's take it on down to the hourly chart. Let's see exactly what's going on from this perspective. And you can see that the hourly chart, certainly has a much sooner opportunity to flip into a downtrend, right? If this is the last higher low in the hourly trend count, you have lows, soft higher low, firm higher low happening here. Any sort of hourly lower high underneath 670.50, everybody can start to say from a pattern perspective, hey, look, it's the head and shoulders, right? Fantastic, no problem. If we break down underneath that 667.25, I'm open-minded to trading this market in the downward direction here, which is going to be this level, really Monday's high defining moment at 664.75. If we continue beyond that, I would target this is a very weak level in the market at 662.25. This is not how the proper bottom of an auction should form. So I would expect that to break on a first test. And what should that bring us to? Probably the daily 20, probably into 660.40, where we know we're looking for a daily higher low. Lower edge of the weekly expected move, 20 SMA, the whole 9 yards, it's all right there. So when and if we approach this after forming an hourly downtrend, this will be a firm higher low on the daily. And all we do here is say, okay, does the hourly trend flip back to up? And when it flips back to up, that's where we want to start to get back on the long train, targeting the equal high and then a higher high, looking for upside continuation. The same exact thing happened back over here. Literally use this as a blueprint, right? Here's the similar looking head and shoulders. Hourly trend flips to down underneath the equal low. Where does the hourly trend flip back to up? Well, here's a set of highs, here's a set of lows. This was a higher low the very next day, and this was a higher high. So really right around in here was the time to flip your tone back to being bullish on the hourly trend moving back into an uptrend, and therefore the daily higher low being in. You could take that same exact blueprint and apply it to potentially what may unfold around 660.40. It's not a guarantee it's going to be the exact same, but it's a rough, again, blueprint or guide as to how trends work in unison. Now, this is assuming, right? This is the big assumption here. This is assuming that we are going to form this little head and shoulders up here and move lower. What if we just get consolidation here? What if the market bounces off of, and I personally love to draw these little inverted head and shoulders. You guys know that. What if the market gets this? Is that just not a sort of equal low in the trend count from here to here? Of course it is. So the hourly trend might neutralize, and then once the hourly trend continues to break out, it's just new blue sky territories up and over that 672.50, which might look something like this, right? You get this, and then you consolidate for a bit. Maybe you get consolidation up here. The trade I would look to get long into is this Brigade bolt over the all-time high at, once again, 672.50. That would be a fantastic long opportunity looking for new price discovery in the upward direction. So all things considered, I don't think the market's in this big position right now to dramatically shift until some of these key levels break. And we could even come in here with some Fibonacci's and just see if we're getting any confluence. I actually have not done this yet, so we're doing it here for the first time together. Fib 38.2 is kind of in no man's land. Maybe it's sort of confluence with that Monday high from last week a little bit. It would have been better if this would have been confluence here. It would have really reinforced that 667.25. It's not. What I would say, though, is the Fib 61.8 is sort of acting as a line in the sand here towards that 660.40. So I do like it from that perspective on the Fib. Let's come in with the anchored view apps intraday and see what this has for us. And what do we see? Notice that this anchored view app, which comes from the major low way back over here, that major low anchored view app will slowly offer confluence at 660.40, so that's a helping hand. This pink anchored view app is the FOMC anchored view app, and notice how all of these are starting to curl higher. This is starting to curl higher. That's Monday's anchored view app. So if we could stay over 667.25 and then maybe digest sideways by time and let these play confluence and catch up, maybe we start to get some pickup off of that. That's one possible scenario. If we were to break down underneath this anchored view app, perhaps this is going to start to act as a target, this cluster in here at 664.75, which would validate that first target. One alternate pathing situation might be, okay, if we support that anchored view app stack and then do something that looks like this, that's probably a long on the recapture of 667.25. Right? And that looks pretty good for upside there. You could also say, if the market were to sort of hold this and then rally to recover over that Thursday high from the gap up, you're probably dealing with an all-time high anchored view app recapture as well, and you want to lean bullish above the entirety of the stack, looking for that upside continuation. So again, there's nothing really here that is overly indicative of, oh my goodness, the market's going to crash and burn and go to zero. If we start to see trends reversing, if we start to see the daily trend really under threat for a reversal to the downside, then fine, we'll change our tone, but we're just not there yet, which is something that I want to reinforce. And the main reason for that, right, is just because we are continuing to see that sector rotation. We'll talk much more about sector rotation when we get into the sector analysis, but just at a high level before we continue into like NASDAQ and small caps, look at the sector performance. You're not going to get a market crash if healthcare is performing up 6.75% on the week. Market's not going to crash with that situation. Semiconductors, although it seems like the AI trade might be slowing down, semiconductors themselves up 3.7%. The market's just not going to crash when you're getting performance that looks like this, and you have those weekly trends, those daily trends on those sectors, certainly in the upward direction. So that's what we've got in the spiders here. Let's take a look at the market internals for some more supporting evidence. If you're not familiar with this dashboard, check out the video tutorial in the top right-hand corner. Generally, as Friday saw a sell-off into the end of day, right? This rotation after failing the new all-time high, what did the internals posture look like? Was it aggressively bearish, or should we not really be that concerned? Well, technically, volume is still inflows to the market. The advanced decline line is still technically positive. The cumulative tick is really not all that negative. It's not like everybody was sitting on a negative tick all day and just building this thing out to negative 5,000. It wasn't the case. It was much more of an evenly distributed tick over and under the zero line. You didn't really see that slam to the downside. A little bit volatile here, admittedly, underneath negative 1,000 on the sort of full rotation to the low. But in terms of net selling pressure through the day, with sellers just continuously hammering the market, it's just not there, right? It's just absolutely not there. And one thing that we should even, looks like this might be what's going on here. Thinkorswim, a little bit of a breakage as we come into the weekend, a little bit of maintenance. There we go. I do just want to look at the index score, because remember, the index score tells us, based on the heavyweight components of the market, how bad things may actually be under the hood. If you take a look at this, I mean, on Friday, yeah, it flipped negative, but was it in double-digit territory negative? Was it in this red lower zone? Absolutely not. Let me just zoom in on Friday and let's just make the histogram. Let's go full screen. Why not? Why not? Let's make the histogram much larger so you can see this. I mean, the worst we had here was a -6. A -6 on Friday as the market was selling off intraday. What appeared to be volatile and fairly aggressive really wasn't sustained at the index score level. So am I overly concerned about new money sellers participating in this market, causing just absolute Armageddon top to be put in? It's the end of ages and that's going to be it? It doesn't look like it as of right now. Now, in hindsight, right, if in 3 months from now it's like, oh wow, that actually was the top, great. We'll change our tone to being bearish when those daily trends, those weekly trends, those monthly trends actually flip to down. And there will be plenty of opportunity to short, and get involved in the downside. But as of right now, again, just think of it from this perspective. How many times have you heard people say, as this rally has been taking place, and I love the fact, right, that there's still some money managers who are cash on the sidelines ever since the April tariffs, right? How many times did you hear here? That's it. That's the top. We're not going to go on to make a new all-time high. Oh, that's it. Market's going to crash. It's going to burn. oh, that's it, the labor report's bad, market's going to zero, right? How many times has this taken place, and how many times have sellers gotten absolutely blown out of the water as we continue this grind? So even if you don't want to be long, if you're like, Matt, I'm really uncomfortable being long up here, it just doesn't make sense, I'm not comfortable, I can't do it. Fine, at least don't be short the market. It does not make sense to be short the market as of right now, based on a number of indications that we'll continue to see. And again, could there be a short for a trade in here? Could there be a scalp, a trade like that? Yes, but generally speaking, the trend is still our friend, number one, and still in the upward direction with an opportunity over that daily 20 to offer a nice higher low. So that's the overall take on the market for the S&P. Let's jump on over to, let's finish it up actually, the S&P with the market profile. If you're not familiar with the market profile, check out the video tutorial in the top right-hand corner. What do we see over here? Value into the end of the week still shifts higher, even though there was that intraday sell, right? So poor low here could use some repair. I think it would just reinforce what we've already talked about. If we take out this sort of zone right around in here, if we take out Friday's low and some, the market may pull back a little bit. And I would think if we test Friday's low because it's poor in nature, we could see that sort of break on a first test there. But generally, value continues to move in the upward direction. Remember that on Wednesday, we had it was a quad distribution there. If you take a look at halfback from Wednesday, the market never pulled back deeper than that on the Thursday session when we gapped up and failed, right? So all things considered, really not a bad looking market here, still developing value in the upward direction. I would say that we still have lack of material excess on the F period high. There's only one single excess F period there. So wouldn't be unreasonable, just like we have a poor low or lack of material excess low, we have the same thing at the high, meaning that as we're looking for that euphoric big bang moment, oh my goodness, that's the excess high, we just don't have it. Remember, auctions end on a bang, not a whimper. Think of it like a car auction. Think of it like a painting auction, whatever it is, your favorite item auctioning, right? It's two people down to the bitter end, and then what happens, right? It gets way, way crazy. One of them steps away. That's the high, right? We just don't have that. We do not have that euphoric excess high here from an auction theory perspective. Let's jump back on over to the platform. Let's take a look at the QQQ and see what's going on with our NASDAQ monthly time scale, and let's see what we've got. Here we go. September bar, very similar to the S&P 500. Solid green bodied bar, minimal wick, strong close towards the highs of the monthly range. In terms of candle by candle count for location, higher low, higher high close outside of and above prior month's range. Brand new all-time high close. Monthly trend remains in the upward direction. You can clearly see if the monthly trend is going to pull back. Plenty of room for a higher low opportunity here. No problemo, looking pretty darn good. Let's continue through to the weekly chart. And let's see what we have over here. Remember, this weekly balance led to a breakout. So if the weekly chart is going to pull back, once again, this is A-OK for a weekly higher low as well. This is your monthly higher low down here. That's your weekly higher low up there. So really paying close attention to about 578s, 579s on the QQQ. As long as we're above that, we're looking good from a weekly perspective. One thing I will call out in terms of candle structure and location is that the candle closes right at the high of the previous week's range rather than above the previous week's range ever so slightly, like the S&P 500. It's not the end of the world, but it is sort of a reinforcing data point to just suggest that the rotation in the S&P is a little bit more broad-based, right? Instead of in the NASDAQ, it's much more concentrated in tech. If the AI trade is going to see, again, not a bubble-popping event, but if the AI trade is going to pull back from this really euphoric rally that it's been on recently, obviously the NASDAQ is likely going to suffer slightly more than your more well-rounded S&P 500. So that to me makes sense here when we're looking at the candle structure and location. If we bring out the Fibonacci's from the bottom of this move up to the top, remember that the top end of the balance range is well above the Fib 38.2, classifying all of this as bull flag consolidation on the weekly. Really no concerns from that perspective. Let's just come in from the tariff lows to the new high. Again, what we continue to check in on is whether or not we're going to get confluence at the Fib 38.2 at the previous all-time high. We're working on it, but we're not all the way there yet. Let's jump in here with our anchored view apps on the weekly NASDAQ. You can see we're above the entirety of the stack. And once again, doing something that looks like this, you could clearly see that the anchored view app cluster is going to be confluence with the top end of the balance range, reinforcing that point. Let's come in here with the volume profile weekly. There we go. Let's zoom out, and I just want to see where the high volume node is underneath us. Lo and behold, it's actually last week's low. So if we were to take out last week's low, you might get a little bit of pullback to what? Does all of this make sense? It should. There's your high volume node. There's the top end of the weekly balance range. So all set there. Let's drop this thing down to a daily chart. Let's evaluate the weekly expected move, the whole 9 yards, and see what's on tap for the upcoming sessions. Here we go. So expected move is here, the gray box as always. You can see the upper edge is 613.57, implying a brand new all-time high and a higher high in the trend count. And here the lower edge is at 592.79, implying a higher low in the trend count. And I would certainly just say that this is a bullish expected move. It's a little bit more neutral than the S&P in the sense that this to this is not as staggering of a higher low, I suppose is one way that you might describe that. Do note that the ideal higher low would be if this trend on the hourly flips to down. It's very close because we just have a back-to-back balance. The hourly trend is neutral in there. If we take out the two equal lows, which is basically the same premise as the S&P 500, if we fail this previous high underneath the Thursday, Friday low, the hourly trend flips to down. I would love to see a daily higher low at 596.75. Now, here's a little nuance about 596.75 that we should pay attention to. See how equal these lows are here, 1 and 2 from Tuesday and then Wednesday? That's really the improper end of the auction, just like we talked about in the S&P to the upside. It's the same thing at any given high and low. You want to see excess on the highs, you want to see excess on the lows. So to me, if the market does flip into an hourly downtrend to cause this pullback, you really don't want to see a perfect test of 596.75. You actually want to see an overshoot of that level that then reclaims, and then we have a nice long in the upward direction once there's an excess low in, right? So I would watch out for that. It could be confluence with the daily 20. That would be interesting if it looks something like that. It's a possibility. Let's just pay attention to that. But once again, calling out that these lows are very equal and some excess there would be helpful in terms of candle structure. This is assuming we're going to break down underneath these equal lows from here on Thursday and Friday. If we continue the hourly balance, then let's just call it for what it is. It's another building block in the upward direction, right? You could always think of the market as little ranges. Here's a 2-day range, here's a 3-day range. If this builds out as a 3, 4, 5-day range, whatever, it's another building block in the upward direction, and we want to go with when and if that were to take out the all-time high level at 607.15. Because this is a 2-day high, I'd be a little bit more compelled to go with the QQQ over those highs versus the S&P, which just has that single Friday high in the upper wick of the Friday bar. So let's take it on down to the hourly chart and see what else we can learn from this perspective. If we take a look, once again, here's your neutral trend on the hourly. You have highs, lows, equal lows, right? So no hourly trend in this box, which pretty much means in the box, keep a very open mind. Stay patient, and as we say here around the trade brigade, right, we want to see a BB, here we go, trademark BBOOBB. What does it stand for? If you know, drop it in the comments now before I say it. This, of course, is trademarked. It's registered, and we're working on the copyright. It's the final thing to go through. We want a Brigade bolt out of the boredom box. That's what that means, right? So what does that look like? A Brigade bolt out of the boredom box is either this in the upward direction or this in the downward direction. Very simple stuff, right? A lot of people call it balance rules. You could call it whatever you want. You could call it break and retest. You could call it all sorts of stuff, tagging up. It doesn't matter what you want to call it. Here at the Trade Brigade, it is the BBOOBB, the Brigade bolt out of the boredom box. Show me the money on the move over that 607.15 for trend continuation. Show me the money for the breakdown underneath 601.65 for a pullback to emerge on the daily. And then show me the excess, most importantly, underneath the equal lows from here at 596.75. Overshoot, reclaim, and then let's rock and roll back in the upward direction if this is truly going to set a daily higher low. Okay, so that is pretty much the base case of what I would be looking for in the QQQ NASDAQ. Of course, another situation to pay attention to here is because this is the improper end, there is no excess at the high end of the 2-day range. If you go look above and fail, meaning you come back down into the range, lower high here, you could attempt the short into the bottom end of the range. That's classic range rules. You always target the opposing end of the balance from 607.15 down to 601.65. From there, I would take the same approach to this downside path here. Okay, that is what we've got out of the QQQ. We could come in here with the Fibonacci's like we did in the S&P. Let's come in from this low up to this high, and what do we see? Not a whole lot of anything other than maybe the 61.8 is helping us with that overshoot right down here. You can see that it's slightly underneath that 596.75. If the market were to change that trend, come in and overshoot but support the 61.8, that looks pretty good. The Fib 38.2 is kind of in no man's land. You get a little bit of this sort of spot here from all of that consolidation and congestion from the Monday-Tuesday session, right? Maybe a little bit to, have at 600, which is the nice round Jesse Livermore number anyways. So you could pay attention to that, but it wouldn't be my favorite level. My favorite levels are here, here, and then of course just all-time high over that 607.15. Let's quickly check in on the anchored view apps intraday, see what this has for us. Notice the perfect confluence from Monday. So if you crack that Friday low, I think the door is open to this stack. If we just balance over here and these anchored view apps slowly catch up, and it could be later week, we'll see what the timing looks like. But if we get this to catch up, maybe it's a correction through time, and then we just go with the Brigade bolt over the all-time high as we described on the daily time scale. Anyways, that would be your upward direction. Where does the daily trend probably fall into more trouble? If we don't hold this higher low here at 596.75, let's just say that we look like this on the hourly, we attempt it, but we set a lower high, and then we're through. That would start to become concerning, and I would at least expect some kind of equal low attempt to this move over here Thursday of 2 weeks ago now. That would be 588.35. Now you could start to see how maybe this starts to look like this, a little bit of head and shoulders action through this neckline, through the unaffected FOMC price from back here and that Thursday low of last week. That's where I would really say, okay, the daily trend is flipping to down. Now we have an issue. Now we have a red flag. Now we can be much more aggressive in terms of trading the downside. Okay, so that hopefully covers you in terms of where the thesis, where the primary situation for the bull is invalidated. Let's take a look at the NASDAQ internals. You can clearly see strong volume inflows twice on that Friday session here, falling out of it, advanced decline line wise, falling out of trend higher zone, but not the end of the world. It certainly didn't flip negative. And look at your cumulative build on Friday. It still technically closes positive, so that's kind of impressive there. Let's take a look over at the market profile for the NASDAQ and finish up on a strong note here. What do we see out of the structure and the profile? So not quite as strong as what we saw in the actual structural chart, right? The NASDAQ futures here are slightly different in the sense that you clearly overshot the low of that Thursday session versus an equal low like what we had in the QQQ cash market. You'll also notice that value, it's completely engulfing of the Thursday session, but look at the point of control, migrating slightly lower into that end of day there. So small red flags, and once again, the thing that I would just lean back into as a general premise here of the tech side of the market is the NASDAQ is not as well-rounded as the S&P. So am I shocked to see some slightly more bearish nuances in the NASDAQ versus the ES? Not really. This makes a lot of sense to me, considering sort of the way we've poised today's analysis, given the sector rotation theme that's really dominating the S&P 500 right now. Let's jump on into the IWM, the small caps over here. Let me just give this a little reset, and then we'll bump it up to the monthly time scale, and we'll see what's going on there. So monthly chart for smalls. Very, very impressive looking chart. You can see we're back above the all-time high zone here. And even if you want to take the wick of this bar, notice that we closed, on Friday, the October bar is very, very early, and, we're not even close to being closed. But notice this breakout level, right? You sort of have, I wouldn't really call it cup and handle. Maybe some people would, but, you get this sort of cup and handle maybe. I would just sort of count it as lows and highs. And it looks like if this range, if this base is going to break out, there's hypothetically a lot higher for small caps to go. Now, as we know, a very rough rule of thumb. This is not a guarantee. This is not, oh my God, it's going to happen next week. But generally, you're looking for a range double when you break out of a range like this. So that might bring us closer to about 318s, give or take, over the span of, again, many months here in small caps, if this is going to break out. Now, there is a phenomenon here that I would pay attention to, which is called, I call it wall-to-wall, A to B. It's basically the premise of moving from the bottom of a range, let's just say A, to B with no pullbacks, right? The best thing that could happen here is a very shallow pullback that reattempts the high after a higher low. The odds of breaking through it, let's just call this point C after a second touch, or I guess it would be if this is first, second, third, that would be fourth. On the fourth go there, the odds of breaking out are much, much higher if you're coming from a higher low, not the wall-to-wall A to B move. Think about all the effort that buyers had to exert to get here. Now we're at a clear, visible area of resistance. Does it make sense for people to be more aggressive or to be profit takers into resistance? Probably the latter. Let it cool off, let people reload, let the volume turn over, and then new positions should, I want to be careful with my emotional terms. I was going to say explode this higher, but I would just say give a better offering of a breakout if we have some volume turnover happening here for a substantial higher low. All right, go study bases, go study breakouts. You'll see this time and time again. So that's what we have on the monthly. There's really no comment in terms of a Fibonacci retracement or a trend or anything. It's really just a balance range on the monthly. So let's drop it on down to the weekly chart here. Let's get a little bit more granular. What we like about this weekly chart is just that the inverted hammer / the indecisive doji didn't yield a breakdown after failing to go higher over the previous week's range last week, right? So or 2 weeks ago now. So we have that same situation where we technically looked over the previous week's high, still closing in the previous week's range, but it's a green-bodied bar. I would just say that the market's getting a little bit more grindy here out of small caps, and you've seen this intraday, obviously, if you've been watching on the intraday timescale. It doesn't do anything to change the trend. The trend is still up. There's still plenty of room for a weekly higher low. Should we break down something that looks like this, we'll keep the trend in the upward direction. No issues off of about 226, as we'll see on the daily in just a moment. Let's quickly come in with the fibs from the April low up to the new high. You can see that this is happening over the fib 38.2. If we come in from this low up to this high, you'll notice that the fib 61.8 is still beautiful confluence there. It really didn't move based on last week. Let's take a look at the anchored VWAPs, which we did update last week to include this pullback low. Notice we're above the entirety of the stack. Really no issues from a VWAP perspective either. Let's jump into the volume profile, and this will be interesting, especially on a slightly higher time scale, such that we can see where the volume is from this long, it's basically just a long period of consolidation out of small caps. Notice that we're above the entirety of the highest volume node, which is that weekly pullback level. As long as we're above that, I would say that the market is feeling or looking pretty good, again, for that possible poised breakout into blue sky territories in smalls if we can get this follow through up and over the sort of 1, 2, 3 equal highs here. Let's drop this thing down to a daily chart and let's take a look. And as we're going through sort of small caps as well, be thinking about what this means for the S&P 500. If small caps really start to get in gear for that weekly or monthly breakout, that probably speaks to the broadening nature of the market rally, not some sort of, oh my goodness, everything's going to crash and burn and we're headed into this dark period for the market, right? If small caps are going to perform well here, that's really not what you see in early stage bear markets. It's actually what you see in late stage bull markets, right? So anyhow, looking pretty darn good in terms of smalls and helping the narrative for buyers thus far. Weekly expected move is here. You can see we've got 250.76, brand new all-time high, higher high, and you've got 240.90 as a potential higher low. One thing I will call out about these small caps, and we saw this on the weekly chart, right, is just that it's getting much more grindy in this phase here. So I'd really encourage you to let the chart work for you, right? And I always say this with the group in the morning, everything, on the YouTube live stream, the whole 9 yards. Make charts that work for you. I'm not actively trading small caps here. I just want to use this as a gauge for the broad market. So my simplification here is you can see I have far fewer levels on the IWM chart than something like the Qs or the S&P. So all I'm going to do here is say, okay, I'm going to remain bullish if we're over the gap up from Friday. I'm definitely bullish if we're over into blue sky territories. If we're in here, I'm probably neutral, but I'm not bearish. If we get here, I'm neutral, but I'm probably leaning a little bit more bearish. And if we take out 238.50, that's where I'm going to say, okay, what is up with this failed breakout from the balance range on Friday? Why are we underneath range lows? Probably not looking good and probably dealing with that sharper opportunity for a weekly pullback. So really, keep it simple here on your smalls. Big, you could call it a shooting star, inverted hammer, whatever you want to call it, from Friday. It doesn't look the greatest, but it's still technically over the top end of this range. So 244.98, I would use 247.63. That's probably an imprecise level that needs a little bit of adjustment. Yes, indeed. Let's go 65 on that. You guys know the deal. Round numbers only up here in the office. There we go. On the hourly chart, there's not much more to glean. Obviously, you're in an hourly uptrend. You have lows, higher lows, higher lows. Higher lows could easily persist on a gap fill reversal. I'd be long and remain bullish in this situation here. Once again, something that looks like this, probably back to neutral. In here, something that's probably like, okay, bearish to neutral, anticipating the possibility of a break, and then definitely bearish down in here underneath 238.50 as we just described. In terms of Fibonacci's, let's come in here with this up to this. You could see your fib 38.2 is the perfect gap fill reversal, once again giving the bulls the benefit of the doubt to begin, and 61.8 is the neckline of what was both the double top from here but also the double bottom from here. So as long as we're over that spot at 241.65, again, I don't think it makes sense to be any more aggressive on the bear side than you have to be. You're still over the daily 20 SMA as well. If that's taking place, you're still battling for a daily higher low. No problems there. Let's come in with the intraday anchored VWAPs for small caps here and just see what else we can learn. Look at the cluster. Look at the cluster there. So once again, I mean, just total, let the charts work for you. Don't be sort of like, oh, is it bullish? Is it bear? Just let the chart help you make the decision you need to make. As long as we're above the cluster, as long as we're above 241.65, this is helping me make the decision that the broad market rally is broadening out. Thank you to small caps as being an indication. So that's all I've really got on IWM. We could take a look at the Russell market internals and see what we have over here. Really substantial volume inflows on that Friday session, very similar to the NASDAQ, opening near and getting close to trend higher zone, but closing a little bit more weaker, weak into the close there to close the week. So how many times can we say weak in the same sentence? We've got a cumulative build that closes slightly red, but again, two-sided action above and below the zero mark, really not overly concerning, especially considering that the day did technically have a fairly large reversal into the afternoon. Am I overly concerned about this? Not really. Not really. A stronger bearish environment on smalls would have been to just immediately fade the gap and get acceptance inside of Thursday's range, and it just didn't happen. So all things considered, I still feel pretty content with the analysis thus far on our small cap side of the market. Let's finish it off with a good look at the RTY futures here, just to get a sense. Look at this. Look at that's a pretty bulky looking profile here. Doesn't really give us much of a beautiful normal curve, but it's not indicative of anything other than just, okay, there's small progress in the upward direction. We didn't really close strong, but look at value. Value here, value here. Look at point of control. Look at point of control. Look at the excess low in A period, lack of material excess in C period. I would say that the all-time high needs more repair than the low of this pullback. If we were to do this, you could repair this by trading through it on the gap fill reversal. Then anything back inside of Friday's range would then be bullish, right? It's the same exact concept that we just talked about over here, where if we do something that looks like this, you want to be long or at least bullish for the broad market back over 244.98. And the reason I'm leaving that 98 instead of rounding to 45 is because it was the exact all-time high from way off to the left. That's going to do it for our three indices. Let's take a look through the sectors now, because this is important. As we know, the market did make a new high into the end of the week. So what was the weekly performance looking like from a sector point of view? You can see healthcare leads the pack, 674 basis points. You can see semiconductors up 370 basis points. Then we have utilities up 247 basis points. I don't know about you, but the only sector in there that screams risk on is semiconductors. Aside from that, healthcare is defensive, utilities are defensive. But what do we know about both of these sectors? And I would strongly encourage you, if you did not watch Wednesday's video, we talked about this concept in detail in Wednesday's video. Skip the beginning part, just go straight to the sector chapter and listen to the commentary there, because it's exactly what happened into the end of the week. As long as healthcare remains strong, it does not matter what's going on with tech. It does not really matter what's going on with utilities. What matters is what's happening between healthcare, and what matters is what's going on with financials. Because healthcare remains strong, overshadowing some of this weakness to end the week or just generally be down on the week in financials, I don't think that we have a situation where, oh my goodness, the market's going to crash and burn. It's just not going to happen unless all of these sectors are at the same time, the heavyweight tech sectors pulling back, trying to get higher lows, but then you're seeing a failed breakout in the XLV and a breakdown in the XLF, and we do not have that, right? At the bottom end of the barrel, it's energy, communications, discretionary. That's not great. Ideally, communications and discretionary would be performing towards the top because those are more heavyweight risk-on sectors. But again, this theme of rotation, it's more than being compensated by healthcare being up 6.74% in a sector that's like unheard of outside of, semiconductors on some of the major NVIDIA rallies that we've seen over the last couple of years. So to see healthcare up like this, and obviously, right, the announcement on the cost of drugs basically was a huge driver there. So let's just take a look through these charts. Obviously, the breakout here is lifting a huge amount for the S&P 500, right? So huge break of this balance range. For me, I would just have to remain bullish on this chart. There's plenty of room. You could get something that looks like this, higher low over the top end of the range. Probably don't want to go all the way back down there immediately, but any consolidation and digestion up here looks really good for healthcare, right? So is this a sector that's worth keeping an eye on? I think that a majority of the momentum break has mostly taken place. If you were to take the same approach that we were just talking about with a range double on IWM and do the same thing here for XLV, you're probably talking about like 148. You're very close to that, right? So your risk reward has actually flipped. Very likely, it makes more sense to be long here, targeting this high, versus being long here, targeting this high with a stop here. It's inverted, right? You would never do that. So all things considered, I think the chart is bullish. It's helping the S&P 500, and if it pulls back, there's room for a higher low. Now let's continue along and let's keep that context in the back of our brain. If we look at the semiconductors, they're also sitting at the highest high in the trend count. And if they pull back, there's also an offering for a higher low. So is there any major threat here that, oh my goodness, this thing's going to come crashing down like a house of cards? Not really. Markets, as we know, crash from the lows, not from the highs. Now, of course, a topping process happens over time, and there will be some high that marks the high. There just inherently has to be. But as of right now, the same exercise as the S&P 500. What about everybody here who is like, oh my goodness, we're back in range, it's got to crash, right? Blown out. What about this? Gap up, oh my goodness, it's starting to fail again. Oh, look at this gap down, right? It's going to go. No, right? It just didn't go. Blown out again. So until the signs are actually there for a market reversal to be underway, this chart looks bullish in tandem with the context of the XLV. Let's continue along with the same context. Okay, XLU, pull back for a higher low. Fine, no problem. A-OK, over the previous all-time high, not an issue. We look at the tech sector, same concept. Here we go. Anything that's over this would be beautiful high and tight consolidation. I would still argue that this probably offers a higher low relative to this low at the daily 20. No problems there. So all good on the XLK, the heaviest weight risk on component. Let's look at the XLB materials. Really nothing to talk about here. Maybe just a little look below and fail. Moving average resistance there, but it's such a lightweight sector. I wouldn't be concerned with this yet. Let's go industrials, trying to make a break for it on the Friday session, but not really getting follow through. So even if this pulls back, I mean, it's just doing the same thing it's been doing for months now. It's really no comment. It's just in range. Let's continue along to real estate. No comment, just stuck in range. Let's take a look at the TLT. This is bonds. Obviously, this is separate, but just really kind of continuing to keep that floor at 4% in the 10-year rate. Let's take a look at energy. Failed breakout here, coming back down into range. This is actually good from an inflation perspective. It is a avoid inflation sort of situation. We go to crude as a proxy as well. We probably don't want to break down too much further underneath this range low. Otherwise, we start having that conversation about global demand for oil, like what's going on with that, what's going on with the possibility of recession theme to start coming in. So we'll see how long this lasts underneath this shelf of support. If it snaps back in, that would be A-OK. If it really starts to take a tumble, I'd say like 56 on crude starts to become a head scratcher, as in like, okay, not really the greatest indication in terms of growth, but we're just not, I don't think we should have that conversation, noting that GDP on the revisions, what was that, 2 weeks ago now? 2 Thursdays ago, those GDP prints were incredibly strong. Right, so no issues there in terms of that one yet. Let's continue along, though, to communications, back to the sectors. This is a little double top-esque. The only thing I really would say invalidates the idea to be aggressively bearish here is just that the market has retraced this thin structure breakout, and it is finding support Thursday and Friday into the end of the week at 115.65. If this can remain true, and if we can get a break over the two hammer highs into the early stages of this week, I would think, again, thinking about the theme of rotation, it's just a beautiful opportunity for money to maybe flow out of the healthcare sector and into communications. If people are going to sell some healthcare, take some profit there, and rotate into something new, maybe it's communications. Maybe it's over these highs and you do something that looks like that, right? So keep an eye on Meta as well as Google, Netflix a little bit. Let's continue along to discretionary. Tesla really getting hit hard there on that really Thursday's bearish engulfer via the delivery numbers, and then Friday getting a little bit of follow through to the downside as well. What do we see here? I mean, not really a horrible looking chart, all things considered. You get a little bit of double top action. However, I would just say that this lacks material excess at the high. So improper end of the auction on the high. I would like to see an excess high to complete that. And generally, as long as we're in this box, I don't want to move the goalpost too far, but this is a big previous pivot high at 234. As long as we're consolidating above this, I really wouldn't have major concerns here. It's a building block in the upward direction. If we were to take out the neckline more aggressively, I would move the goalpost to 234, not the exact low of this bar. If we were to take that out, now I have some concerns, but we just don't have that as of Friday. As a matter of fact, you technically have an offering of a higher low relative to the neckline of the double top. So if we were to do this, right, I just at that point, right, how is it nothing more than just an ascending triangle at the all-time high? Right? How do we move into blue sky territories there? So really not the end of the world. If we look at the XLF in terms of sector rotation, this was going to be a threat. It was a threat that we've been tracking for a little while. Remember the failed breakout into all-time highs coming back down here. Thursday, a little bit of a saving grace off the daily 50 SMA, not getting that breakdown through 52.90. I would still keep this on your radar as the top watch number. Under 52.90 will be a red flag for the broad market, noting this is the second heaviest weight sector by market cap. But what do we know is true? Healthcare is pulling its weight right now, so it's okay if financials go sideways. A majority of the other lighter weight sectors are pulling their weight, so to speak, right now as this goes sideways and digests. What's the next catalyst here for the XLF? It's probably earnings season, which is not this upcoming week, but the week following that, we will kick off big banks, JP Morgan, Morgan Stanley, Goldman, the whole 9 yards, into about midweek. I think they start on Tuesday before the open. Banks are usually before the open. So Tuesday before the open, I think things kick off. We'll see the earnings calendar when it's ready. But generally, that's the XLF. Not really in a big position here to make a big call. It's balanced until proven otherwise. If it breaks out, you're going to wish you didn't front run the idea and say, oh, I got to short it and it's going to go to zero. The tailwinds are at your back, right? You have this uptrend behind you. So if it fades, that's fine, but I would not get aggressive on it until it's at bare minimum no pun intended, 52.90, right? Let's go to the XLP lightweight sector here, balancing off in these lows. It does look bearish down here with multiple upper wicks here rejecting those rally attempts on Thursday, Friday. If it cracks the low, it will be a bearish issue for the market. However, this alone is not quite enough to have me change my tone in the broad market, right? If we're thinking about evaluating all 11 sectors that we just went through, let's pause for a second and just think to ourselves, hang on a second here. This is one of 11 sectors that's in a downtrend and considerably, weaker than everything else. Am I going to uproot my bullish thesis based on one sector out of 11, of which this is a defensive sector and it's also a lightweight sector? Survey says absolutely not. And if you want a counter data point to this, we can go take a look at something like the XBI. If you guys don't know what the XBI is, it is biotechs. And if we take a look at, obviously it's going to look very similar to your XLV, but take a look at this. If the XBI is going to have a breakout, and it has the same issue as the small caps, really, from A to B, wall-to-wall move, so I wouldn't just be a blind long here. I would love to see something that looks like this and then a hook back into it, basically. But, I mean, XBI on this massive rally here, what do we know about biotechs as a thematic indication, right? Is this risk off or is this risk on? Obviously, it's risk on. Huge R&D costs for a big question mark in terms of return. Huge risk on signals. See that biotechs are rallying the way that they are. And in my view, that could counteract what you're sort of trying to extrapolate from the XLP. If you're getting overly bearish here, if you're like, oh my God, I can't believe it. Consumer staples is getting beat up. It's got to be short. Just like relax. XBI looks pretty darn good here. Looks really good here, actually, up here at the high. So anyways, that is a risk-on indication in and of itself. Speaking of risk-on versus risk-off, let's take some evaluations based on ratios. If you're not familiar with the sector ratios, check out the video tutorial in the top right-hand corner. What do we see here? Obviously, this continues to be the glue that holds the market together. It's the tech ratio. If we look at financials, we know this is a red flag. We know the chart has relative weakness. XLC, I'd prefer to perk up here and hook off the daily 50. We're not there yet. I'd give this a neutral tilde, and this also gets a neutral tilde finally starting to break underneath this last equal low. So the glue that's holding everything together is still the tech market. We're starting to see a little bit of outperformance in the XLV, which, as we know, I think it's a catch-up trade right now. I'm not overly convinced that this is risk off, but the XLU is starting to look slightly risk off. The only counter argument here is that the XLU trade is perking up because of AI data center energy demand, and they're, of course, the deliverers of that. So you could make that argument, but I still believe that utilities will be seen as a defensive class rather than a risk-on class. If we go and take a look at some specialized ratios, you can still see we're batting mostly 6 for 6. I'd say maybe 4 out of 6, right, with the possibility of this lower high on utilities and this lower high in small cap growth versus value. However, generally, all of these charts are still in uptrends, and I would not change my tone to risk off just yet. Let's take a look at the B ratios. If you take a look at gold, it's still outperforming. Gold continues to look really good, but what looks even better is actually silver at this point for a multi-year breakout high. We'll take a look at the SLV chart in just a second. Here's your TLT ratio continuing to move in the downward direction, speaking of the risk appetite remaining elevated. And Bitcoin, how could you not be talking about Bitcoin? A little salty about Bitcoin, having stopped out of a swing trade on it in here, only to see it go exactly to the target. But I think there's still opportunity on Bitcoin. I would love to see, just like we've been talking about, you've got a wall-to-wall move, A to B. I would love to see a higher low pullback, and if we can hook back into the high, probably a breakout we want to go with in Bitcoin. That would speak positively to risk appetite. If we just go back to the weekly chart for a second, I would point out that the Sailor Shift tool has fired a green signal, meaning that Bitcoin is actually doing better than gold right now. Gold, as we know, has been on a tear. If you take a look at this thing, breaking out of this wedge here. But let's look at silver, SLV. And what we want to do is go to a monthly. This is a crazy looking chart. Let's go to a monthly chart here. Take a look at SLV. Actually isn't, I don't think it's old enough, right? Let's go SI futures. Yeah, there we go. This is what we want. There's your 50 handle on silver. If silver gets a break up and over 50, wow. What I would really want to see to help, drive this thesis forward, I'm going to come into here real quick and let's edit this, and let's say GLD, SLV. So what we want to see here is an inversion of the trend, right? Let's hit OK. So I would like to see, let's actually, how do I want to do this? Technically, we should invert this. So we want SLV on top and GLD on bottom. Okay. So what we want to see here is a continuation of, let's go to a weekly chart, right? Let's go full screen. Thanks for bearing with me. I think that this is a conversation worth having. On silver, I would want to see a break of this sort of downtrend happening here, right? This is the ratio of, ignore this little label. This is silver to gold. So you want silver to outperform. Yes, it's come up from the bottom, but in a big way, it's still, this is a counter trend move in the context of a downtrend, right? So if silver is going to break the weekly resistance trend line on a ratio, that would improve the odds that I would think maybe 50 gets the breakout on the monthly chart. Okay, so silver, pretty interesting and cool opportunity here. Let's go back on over to the set and continue along with the dollar and rates. Kind of unchanged here on the dollar. Obviously, I think the market's just holding its breath, waiting for the government data after the shutdown. We'll get the BLS report whenever they decide to reopen things up. So kind of tentative there. If we jump into the inverted ZT, kind of mild in here as well. Let's just jump over to the Fed tracker tool and see what we have on FedWatch. Let's jump into our probabilities tab here. So sitting at 96.2% odds of the cut come the end of October. I think the market's still looking forward to that based on the labor data that we did get. Remember that we did get JOLTS early in the week, and we also got ADP private payrolls, as well as the ISM manufacturing and services report. So instead of just actually telling you, let me show you, and you can see these things. So JOLTS came in stronger than the expectations. I think that this is technically going to put a damper on the odds for Fed rate cuts. And if we take a look at the ADP non-farm, this unwinds it, right? Huge miss coming in at negative 32, meaning a contraction of jobs on ADP, and previous got revised down from 54 to negative 3. That is a big revision to the downside. So you're getting negative on the non-farm, change in employment, but the job openings have actually increased apparently. If you take a look at the breakdown of ISM manufacturing is going to be better seen over here. Let's jump into where is manufacturing. There we go. Manufacturing employment actually seeing an uptick over prior and beating expectations. So this is another mixed data point. Remember that stronger employment data will reduce the odds for a Fed rate cut. The market will not like that. So far, it's been a really mixed bag. We've got JOLTS that's strong, we've got manufacturing employment that's strong, and we have ADP non-farm that's weak. If we take a look at the ISM services report, which is just a little bit lower, you can see employment here, actual 47.2, previous 46.5, another stronger than expected report private, but from the ISM services, you could see employment on both manufacturing and services a little stronger than the market was anticipating. So all things considered, the only weak data point here is the NFP. I wouldn't be shocked if when the report actually comes out from the BLS, you see a kind of similar situation where the unemployment rate is probably unchanged. Unemployment rate will likely stay at a 4.3. You'll probably see NFP, continue to look really, really soft. And I think the market sort of has to come to terms with, okay, we're sort of in that precarious position, as Jerome Powell calls it, the curious balance with the labor market. And from there, if labor doesn't really deteriorate on the unemployment front, the shift might be over to prices, aka inflation, right? You can see here actual 69.4, previous 69.2. That's a little bit hotter than what the market was thinking it was going to get, as well as the prior read. Services inflation, I wouldn't say explicitly linked to services prices, but, to some degree it is. But the point of the exercise is that when it comes to this report, right, there's about a 6-month delay there. We know that this has been really elevated. Take a look at this. Take a look at this. Let's just do it. Let's go consumer CPI. Can I just type CPI? Yeah, inflation rate. That's fine. And let's go out to a 5-year, 10-year chart. Yeah, great. There we go. So you have ISM prices, services prices in blue, and inflation in gray. See how closely these things are linked? See how they're divergent as of right now? So the market may start to focus a little bit more so on the inflation data if the labor situation is not as bad as anticipated, right? So it's this continued back and forth, back and forth, back and forth. And what would gold be saying about this? Like, is gold saying that this is something that we should worry about? I mean, heck, that's what it seems like. The bond market's not fully on board right now, but this is loosely the conversation that I think is relevant when it comes to these economic data points. As a reminder, here is, oh no, I'll have to throw it in the edit. Just a reminder, it's a table of the performance of the market during a government shutdown. And if you know the stats, we've been covering them all the time. 0% return on average over all the measured instances, 50-50 coin toss, positive or negative. So just don't let the government shutdown overly influence your decision-making process here. Let's take a look at the earnings calendar. Nothing to really pay attention to. Maybe Pepsi into Thursday before the open. But remember, it's not this week, it's the following week where we'll start to get the big banks firing things off, and we should pay attention for any indications there. Let's continue through the supporting evidence and see what else we've got here today. Bonds in relationship to themselves. So what do we have? If this starts to break out, it would just put a little bit of pressure on the expectations of a rate cut and speak more to inflation in the short term, or at least less of an emphasis on the labor situation being poor. Let's take a look at the credit spread ratios. Downtrend. So a little bit of an uptick happening here into the end of the week, but nothing overly concerning. Still in major trends to the downside overall. If we look at the junk bonds, they are not even close to setting those highs. So if we just throw in the SPX here, we called this out on Wednesday. A little bit of a divergence still. So if you're a little skeptical of the S&P, again, I wouldn't necessarily be short it, but I would be very cautious of new money longs at the highest high if you're still divergent in junk bonds over here. This is one indication of the many we've looked at so far that would indicate risk appetite's not all the way there. Let's jump into our breadth and see what we've got here. This is an echo of sentiment from the IWM, basically, improvements out of the moving average charts, as well as new highs versus lows. And if we take a look at our good friend, the RSP, it did technically break out of the balance range on Friday, which is bullish for markets overall. If we look at the QQQE, it looks very similar in the sense that it is continuing its uptrend. It is not going sideways. Breadth is improving as this market rally extends into new highs. Let's take a look at volatility. It looks very normal here, no concerns on Friday out of the VIX. The VVIX looks very normal as well. No concerns over here. And volatility futures are still in a very deep contango. No issues out of that. Not even close to backwardation. Same thing, 9 versus 30-day VIX. And the 1-day VIX is very, very comfortable in its sweet spot, in its home between 745 and 1275. Let's take a look through the core list of companies, and then I've got 4 trade ideas for you. Let's get off of maybe some monthly charts here. Let's go back down to a daily. Let's give this a reset, actually, just so we're back at square one. Let's go to NVIDIA, and there we go. So what do we have? I think that the breakout into new highs it was good for one session, and I think from there it's been very lackluster. And I would carry that forward as a data point, right? Usually a break of such a major level like this, after so much volume turnover in this balance range here through an earnings cycle, meant to point at that, you would expect a larger breakout as people decide to either get re-involved in the AI trade here, or breakout buyers add to their position, momentum buyers, intraday traders, the whole 9 yards. You just didn't really see that. I'm not going to be bearish on the NVIDIA chart here unless there's a clear breakdown back underneath 183.75. So on the daily chart, Brigade Bolt is still definitely an offering, but I'm a little, I don't want to say concerned, but I would have expected different reactions here on a breakout to new highs, considering all of the sort of hot button stuff going on with AI right now. Didn't really see it. So if we take a look at the hourly chart, you can kind of see it as well. It was good for one breakout through here, and then you really would have had to buy the pullback on Wednesday. Other than that, it's been a horrible, horrible name to be in from an intraday perspective. So patience until we get here, maybe reevaluate for more structural low to be built out. If we just do this, let it turn into a flag and then maybe into new highs, need to see either a new headline, a catalyst here, or just a huge amount of volume come into it on the break to blue sky territories. As of right now, you can see volume is tapered off on the 2-day pullback. So if this is going to come in and just be quiet for a little bit, that's fine. Look for volume to continue to taper. Then when it goes, right, you got to see something impressive in terms of relative volume in like a pre-market session or through the day or something of the sorts. Let's go to Microsoft. Really not much to talk about over here. It's still just one of these old guards of tech that I think has not been very attractive to trade. A little bit of look above and fail action still trying to play out up against that 518.50 bottom end of the range from back here. So as long as we're in the range, when I say range this time, I would just be neutral. There's really nothing to do on that. If it's going to get in gear, I mean, maybe some of these upside trades, but probably just like NVIDIA needs a new catalyst, needs some kind of spark. It needs something. This Microsoft trade here, it just doesn't really have it going on. You're building out a little bit of a weekly higher low. If we go to a weekly chart here, you could say you're building out like a weekly flag, something along these lines. That's fine. But I don't see the really aggressive opportunity for a long, noting some of the other themes that are in play right now. So main idea, just watch 518.50 over or under for this week. If you're under, really not interested in here. Let's jump into Apple. Kind of a weird failed breakout on Wednesday just to sort of reclaim and get there on Friday. I don't think you want to be long anymore into the all-time high. I think that ship has sailed. I think the next trade is just waiting for blue sky territories on Apple over 260.10. If we go down to the hourly chart, you can kind of see how much of a grind it's been. Really lackluster on that Thursday session. Then even here, it was good for a quick scalp on Friday morning, but that was about it. nothing really to say about it. So over 257 keeps the bullish edge here, but the next trade is probably just into new highs over 260.10. So keep it simple on Apple. Next up, Amazon. This is sort of a bear flag. We do have the Prime Day deals, which are going to start coming out. I think it's the 7th and the 8th is Prime Day. So watch out for some headlines around the percentage of sales relative to last year and all sorts of different metrics. That could act as your catalyst here for Amazon. Under the lows, I hate the prospect of being short into the daily 200. Over the highs, I would think it has the opportunity to go, but then ask the question, why did we fail back lower on Friday, right? We opened on a gap up. You actually saw the first hourly bar produce this pretty nice, actually, balance range, right? And then it obviously broke down. So if this was going to be a stronger long, it should have done this, right, to target the moving average cluster. So a little lackluster here on Amazon, Nancy. If it rallies and sets a lower high, maybe it's a short here for the range rotation to the low end. It's a possibility, but just really not a great-looking daily chart, right? There's not a lot of daily what would you say, conclusions to draw from that flag range quite yet. Let's go to Google. Google seems to be pretty stubbornly holding on to, if you were to consider this kind of just like flag, right? It's not breaking down aggressively underneath these 3-day lows from back here. So as a matter of fact, it's just a 3-day high watch now over the daily 20 SMA. You could see, right, if we break out over this 245.85, I would love the prospect of Brigade Bolt up into 249.60. That would be an interesting long for risk reward here. If it just grinds around in the range, not really interested. Let it chop around, let it do its thing. Let's take a look at Metaverse. Metaverse is interesting because it started to show gap fill reversal on Wednesday off of the earnings gap cycle, but Friday really starting to put the pressure back onto the downside. And you could also lean into this, the question of the title / the intro of today's video, is the AI trade over? I mean, Meta is a pretty big player in that space with the Llama models and also spending quite a lot on AI infrastructure, right? So to see this roll over like that on Friday after attempting gap fill reversal for upside has to start, raising the question of, okay, is that your neckline retest rejection of the double top? Are we headed lower in Meta? I think that the better short is underneath, generally, where do we become more of a short? Better short is into this thin structure underneath these 3 equal lows. At this point, you're still shorting into structure. This is where it really starts to open up once we get down here. So we're in a downtrend. There's plenty of, there's intraday opportunity for sure, but I would really look for this chart to clarify. That's one of the themes that's really been going on here recently, is that the old guards of tech, some of these charts really are not offering, I would say, fantastic opportunities one way or another right now. Tesla is not in that category of not offering good opportunity. Really great opportunities happening on Tesla. So watching to see really how the daily 20 SMA reaction holds. Do we support at the bottom end of the range here at 421? Do we balance off? Does it turn into a head and shoulders? Maybe. I would say underneath the 20 starts to target the gap close here. That becomes interesting. And really, once you're into that gap close range, you've got nothing really supportive on Tesla until you're at 365 again. So is there a reversal? Maybe. Should you fight this? Clearly, there's momentum to the upside. It's starting to unwind a little bit here. I wouldn't be aggressively short until there's a clean indication that, yes, this thin structure from point A, let's call it, to point B is available. When this range here is available, that's where I'll look for it. But if we're just doing this, I still think it makes more sense to go in the direction of the breakout from a weekly or monthly perspective. Look at this weekly chart, right? Boom. Look at the monthly chart as well on Tesla. So huge bar in September, breaking out here, a little bit of a pullback. I mean, you could easily get monthly high or low over the breakout range 365. I know we're sort of like traversing higher and higher time frames, so it might not be as relevant for the day-to-day, but you get the idea in terms of general preference about the trend and direction of the chart here. So that's Tesla. I would say that the primary spot to watch is the gap fill area at 402.35 down to 396.70 if you're looking for shorts. If you stay over 421, let it balance off, and I would say there's probably a Brigade Bolt recovery effort over 444.50 into 466.25 back up to this high. If you can reclaim that, right, let's go down to the hourly chart here. Notice how you're just back over Friday's high. If this holds up and you get here, this is a trade I'm interested in. Look at the thin structure. What goes straight up comes straight down. Has the possibility of going straight back up over 444.50. So watching Tesla for that. JP Morgan earnings around the corner, so please be mindful of it. Let's take a look at the daily chart. Bull flag still. I'm really not aggressively trading JP Morgan these days, so we'll watch to see what happens with the bull flag. But for now, I think the earnings is the next big sequence to pay attention to and its implications for financials overall. Palantir, the one stock that probably did lots of folks dirty on that Friday session, down 7.15%. Wow. Notice what's going on here. You have highs, higher highs, lows, lower lows. It's a broadening formation, and if this can support over this level 171.25, that is one heck of a spot, right? Based on this breakout, based on this gap, for Palantir to turn around. So how do we want to execute on this idea? There could easily be some sort of oversold bounce early in the week, but it really becomes a matter of what happens at 177. If you're in here, it's a bear flag. If you're in here, it's back to the long side. It's back to the all-time high. The AI trade doesn't blink twice, right? So 177 is going to be a critical spot to watch based on the daily configuration here. If you're under 171.25, that's where you sort of have to say, okay, hang on a second now. This is the spot where the daily higher low needs to persist. You have lows, higher lows, higher lows. This could be a higher low. The reason I would say that is because the hourly trend didn't really flip to down in this balance range here, right? So now that we've taken out this low on the hourly at least, this is absolutely a higher low. So you get, this is your daily higher low spot. You fail that 171.25. Now all of a sudden you're neutral on Palantir. Now all of a sudden, right, monthly head double top. Now obviously for that to trigger, you got to be underneath the neckline. You got to bring in the lower low. I'm not calling for that. I'm just saying, right, this would certainly help the bear case if you're spending more time underneath this level at 171.25. So that's the nuance there. If you take a look at the hourly chart, notice the first initial attempt to bounce here that was completely gobbled up into the close. I think now, right, it really becomes a matter of cautious in here. And then if you get this 177 recapture, really bullish on that, noting that these buyers are made whole. Anyone who's like, oh my goodness, buy the dip, right? This is where those buyers start to feel a little bit more comfortable and confident over 177. Targeting the top end of the range, be respectful of 180.50 as well. If you're underneath, right, you're just continuing to make bar-to-bar lower lows, sellers in control. Broadcom, what do we see over here? Nice gap up. I'd be sort of interested, that was to end the week. I'd be interested in this continuing to build out an opportunity sort of in this zone between 337.50 and 331.30s. If this continues to pull back, I'd still be interested in this higher low and generally a reversal of this Broadcom pullback, right? If you look at the daily chart, here's your pullback and drift. If we could support this back over the earnings gap up low, that makes a little bit more sense to me at 331.30. So trying to lean long here as long as that higher low can persist, trying to lean into this idea. Time to get short, of course, is just when and if we break back down into the gap that's under 324.60. Next up, AMD. Then we're going to detour before we take a look at Robinhood. AMD, another big reversal on Friday, down over 3.5%. Big reversal, but to where? Right back down to the breakout point. This is going to be a top watch early in the week if we can support over 163.65. If we can support here, then absolutely Brigade Bolt on the daily, right? This is sort of like a big range, and you're just getting that sort of opportunity for a revisit at the breakout point. So can we find longs here? Can we find an hourly trend reversal? There's nothing. There's thin structure here. Their first target is this little hourly level at 168.35, and then 170.60. Flat top, flat top, flat top. That to me would indicate the lack of the auction ending properly. Really, it's about the gap close on the upside target. Going back to the daily, you can see that from back over here. So really, really top watch is going to be 163.65 here out of AMD. I said we were going to detour before Robinhood because we want to take a look at TSM. And this is not inclusive of the 4 additional ideas I have for you. TSM still looks really great. Look at the inside bar on Friday. If this pulls back and supports over this 286 spot, looks real good for a higher low. Obviously, we're going to want to watch the all-time high breakout. Perhaps that's over 296.75 there. So TSM also looking good. We're going to start to tour through some semis, right? So good, boom, boom, boom. Great. Theme remains in play. If you pull back here and can support again, great. Moving here. If you fail this level, right, there's really not a lot of support until you're coming back down to 279.25. So be mindful, right? This, just like any other trade at any other level, you need to have some sort of reasonable stop in here. You need a setup. You need some sort of entry criteria, but the level is incredibly interesting in terms of the opportunity. Let's go over to MU. Let's take a look at Micron. Speaking of just absolutely bonkers moves, that Wednesday rally was huge. So again, plenty of room for a higher low. If some of this AI stuff, hitting the headlines is like, oh my God, the AI trade's going to crash and burn. Just look at this chart. Could this start to indicate bubble-esque territory? Maybe, but until it actually forms a downtrend and drifts off into the oblivion, I would say base case is that you're looking for a higher low here. If it can support, even if it just goes sideways for weeks on end, it's not going to indicate a crash, right? So that's MU. Let's go to ASML. Another one. Excuse me. You could see just high and tight consolidation on the gap up from Thursday. Looks really strong here. A little harder to trade something like ASML with how gappy it is. It's not an ADR. Is it a PLC? What is it? I think it should say over here, right? Oh, it is an ADR. There you go. So American Depository Receipt. I mean, just bullish for semiconductors overall, right? So, excuse me, no problems here That's my signal that it's probably time to start wrapping it up sooner rather than later. INTC is up next. Intel, right, in terms of semiconductors as well. We know it's been hot. It's in the headlines. Chart looks great. As long as it can hold up over 3610, bullish, looking for follow through to the upside. Next major level is 4150. All right, if it starts to crack underneath this 3425, I would expect some pullback. Not overly concerned about it yet, but that would be the spot. All right, that is your semiconductor detour. Let's go back to Hood and finish the core list of companies. And then I have 4 trade ideas for you. Honestly, one of them is going to be a semiconductor as well. What do we have on Robinhood? Straight shot higher. What an impressive week out of Robinhood. Inside bar breaking out on that Thursday session, continuing here. So all things considered, have to remain bullish. I would think that it gets a little harder to try longing this into blue sky territories. If we look at the levels here, I'd love to see consolidation build something out. And honestly, the consolidation could persist all the way for something that's this wide. The more volume turnover we have here, the more likely it is that on a new all-time high breakout attempt, the more likely it is you have new participants who start to get involved. If we crack underneath 138, that's your thin structure retracement. This is a pie in the sky pipe dream of a pullback. If you were to get here, fantastic. Great opportunity. Here it is, right? If you were to get there, right, awesome spot for a daily high or low. Does it keep this trend intact? Of course it does. Of course it does. So watching 130 very closely. I don't know, though, that that is a top priority. I don't think Robinhood's going to just fall out of bed and go here in the blink of an eye. If it does, fine, we'll keep an open mind. But in terms of probabilities, I would think some sort of consolidation, digestion, and then some attempt at continuation over time. Let's finish it up with 4 ideas. Let's just go back to semiconductors. SMCI. Can you believe it? SMCI, if I could spell. One of the charts I said that I would never trade, just noting its sort of issue with the accounting. But let's take a look at the hourly chart. Moving into the gap, obviously, momentum here to the upside. If it can consolidate in Brigade Bolt over 5280, maybe there's a trade on the long side there to close the remainder of the gap up here. And then pullbacks anywhere over 4880s, 48 flat, really look good as well for a daily Brigade Bolt, right? If this is inverted head and shoulders, this is your neckline. Support near that neckline area certainly could offer a higher low and persist the trend and the reversal in the upward direction. That's SMCI. Next up, speaking of S's, let's go to Snow. Snowflake. What do we have here? So a bearish engulfer on the Friday session could lead to a full gap close, but if we can support over the top end of this balance range, and you could even call it sort of inverted head and shoulders-esque, if we could support over 231.80, great. Maybe we go back up to the highs. So watching out for Snow on a reversal off of 231.80. Let's move along to MSTR strategy, which is no longer micro. It's got a very clean breakout point here at 357.75. If you can crack it, thin structure retracement to the gap close, 380 to 385. We know that crypto has been on a tear. We looked at the Bitcoin chart earlier. If strategy is going to participate, it could be a couple of ways. Consolidation here that then goes. Awesome. A gap up over the level, pullback, and then go. Really interested in this 357.75. Coin went, right? If you take a look at Coin is already up and away, looking to see if MicroStrategy, which is no longer micro, just strategy, wants to participate as well. Last but not least, OKLO. On the nuclear front, what do we see over here? Here's a multi-day consolidation starting to break out on Thursday. Beautiful hold at the low of day from Friday at 122.60. A little bit of a 3-bar play setting up here. Anything over that 130.40 should ignite this back up to the all-time high at 142.75. If it fails, right? If it fails, keyword if, through this lows is going to get ugly. Ugly, 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 ugly. So if you try to long this here and you do not have a tight stop, if you're someone who cannot respect the stop loss in a chart, please do not even consider this trade if you can't respect the stop. Because if this level gets taken, if you have a lower high double top on something that has gone parabolic, you are going here, right? And if you are long from here, that is a ugly and long ways away. So that's OKLO. Please understand what you're getting involved in if you decide to get involved. And that is the interesting chart setup that we have. Consolidation here, Brigade Bolt. I would like to see that happen. If it doesn't, no problem. And then underneath this, certainly batten down the hatches. I think it will get ugly. So that's what I've got for you in today's episode of the Weekly Watch List. If you enjoyed the video or learned anything new, let me know down below in the comments section or by giving the video a very simple thumbs up. As always, we will be live every morning of the week, as we typically are at 8 a.m. Eastern Time, for another installation and episode of the Pre-Market Prep. So if you want the latest analysis up to date with what's going on right here, right now, all the way up to about 10 minutes before market open, come back out to the channel every weekday at 8 a.m., the live Pre-Market Prep. We've got you covered, right? Period, full stop, we've got you covered. So hope to see you there. Have a fantastic weekend. Stay green this week, and I will see you in the next one.